Hi there, and thank you for joining us at PhillipCapital's Market Watch. I'm Phil Gunn, Senior Sales Manager from Phillip Nova. In this episode, I'll review the key factors driving the recent surge in gold prices and share my insights on the outlook for spot gold. Let's dive right in. Gold has been a valuable asset throughout history, serving as a store of value, a medium of exchange, and as investment instrument. Its role in the global economy has remained consistent, even as financial markets evolve. Its price trends have reflected broader economic conditions, investor sentiment, and central bank policies. In the early 2000s, gold was traded at relatively low prices, hovering around $250 to $300 per ounce. However, following the 2008 financial crisis, investors sought refuge in gold, causing its price to surge to over US $1,800 per ounce by 2011. More recently, amid heightened inflation concerns and economic uncertainty, gold prices have exceeded $3,000 per ounce. The significance of gold in financial markets is undeniable. It is widely seen as a hedge against inflation and currency devaluation, making it preferred investment during periods of economic instability. Many investors view gold as a safe haven asset, meaning it tends to perform well during financial crises. Furthermore, gold-backed financial instruments, such as exchange-traded funds (ETFs) and futures contracts, allow investors to gain exposure to gold prices without holding the physical metal. Central banks also play a crucial role in the gold market, maintaining gold reserves to stabilize national economies and support their currencies. Gold had a strong start in 2025, with prices rising above US $3,000 per ounce due to increasing demand from investors and central banks amid persistent inflation. One of the biggest drivers of gold prices is inflation. When inflation is high, say above 3 to 4%, the purchasing power of paper money or fiat currency declines, prompting investors to look for an asset that holds its value over time. Gold, which is seen as a store of value, becomes increasingly attractive in these situations. Tariffs also play a role by fueling inflation. When tariffs are imposed, the cost of importing goods rises. Companies often pass this cost on to consumers, resulting in higher prices across the board. Since gold is viewed as a hedge against inflation, demand for it tends to increase when inflationary pressures rise. The second factor that could drive gold prices higher is a slowdown in global economic growth. If we enter a period of stagnation or recession, central banks such as the US Federal Reserve and the European Central Bank will be likely to cut interest rates to stimulate growth. Lower interest rates reduce the opportunity cost of holding gold. Unlike stocks or bonds, gold doesn't pay interest or dividends. In a low interest rate environment, investors are less concerned about this trade-off, especially when returns from savings accounts and bonds are similarly low. Recently, central banks in countries such as China, India, and Russia have been aggressively accumulating gold reserves as part of their strategy to diversify away from the US dollar and reduce their reliance on foreign currency reserves. Over the past decade, these nations have been purchasing hundreds of tons of gold annually. If major economies increase their gold holdings, it creates a supply crunch in the market, further driving prices higher. Finally, one of the most unpredictable but powerful factors driving gold prices is geopolitical uncertainty. Events such as wars, trade disputes, economic sanctions, or supply chain disruptions often drive investors towards gold as a safe haven asset. Shown here is the daily chart of the spot gold. Prices have reached the key $3,000 psychological level and remain highly volatile. In the near term, support is seen at $3,177, which aligns with the 38.2% Fibonacci extension. With the current bullish momentum, prices could next test the 1 Fibonacci extension level at approximately $3,540. Phillip Nova offers forex trading spot gold as well as major currency pairs via the MetaTrader 5 MT5 platform. Enjoy zero commissions when you sign up and open an account online. The MT5 platform is available on both mobile and desktop devices, allowing you to trade anytime, anywhere with a simple installation process. Enjoy 24-hour trading on major forex pairs from as low as 0.6 pips and access daily trick signals provided by Acuity Signal Center on a wide range of assets. There are no maintenance fees, and you can monitor your trades wherever you are, whenever you want. So sign up for a free live trading account now. It takes only a few minutes using your SingPass account. There is absolutely no minimum deposit required. If you sign up using my QR code, you can also sign up for a free one-to-one coaching session. The course will be on technical analysis demonstrated with our Phillip Nova MT5 platform. I'm a dual license holder specializing in futures, forex, and stocks. You'll also receive daily updates on economic data releases and technical advice via WhatsApp. I provide coaching on technical analysis for customers via the Phillip MT5 and Phillip Nova trading platforms. Apart from coaching, I also equip my customers with practical tips on how to better manage their risk to avoid exposure in their positions. Phillip Nova offers demo trading platforms. Our demo platform provides a risk-free environment for you to practice different strategies and techniques. You can experiment with different trading instruments, test out your theories, and see what works best for you. Register your free demo account via this QR code. I'm here to support you every step of the way. If you have any questions, feel free to reach out to me by email. And that's all for this episode of PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. We love to hear from you. What price levels do you think gold will reach in 2025? Share your thoughts in the comment section below. Thanks for watching, and we'll see you in the next episode.